Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Stuart Katz, CIO of Robertson Wealth Management, to discuss how 2020 will impact investment portfolios with the election, key policy priorities, and investment themes. Stuart, it's great to see you. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me.
And what is your perspective on the current environment? We have a lot to unwrap here.
We do have a lot to talk about. Let's discuss the current environment across three categories for a moment: health crisis, economy, and financial markets. In regards to the health crisis first, COVID-related issues are still dominant in regards to personal and business activities. But we are encouraged that despite the resurgence of case counts, both in the US and Europe, that mortality rates are lower, suggesting that the medical profession has a better understanding on how to treat the virus. Second, regarding the economy, we continue to see signs of progress. However, our outlook is that the recovery will be uneven, and so we should fasten our seatbelts for a bumpy ride. Third, in regards to the financial markets, visibility in the markets is improving. The evidence we look at are the recent quarterly calls, the upside revisions that we're seeing in earnings, and the more optimistic outlook across many different senior executives. However, we are expecting lower returns across equities and fixed income as compared with the last cycle, and better relative returns for equities compared with bonds. Finally, regardless of the presidential winner, personal and corporate taxes will need to rise. They need to rise to pay for past and pending fiscal stimulus and state and local budget shortfalls.
So how are you thinking about risk as it relates to the upcoming US election?
Well, two considerations there: time horizon and stimulus. So let's focus on stimulus for a second. We're expecting the F-bomb, the F-bomb in regards to fiscal stimulus. And it's going to be employed whether we have a unified sweep or divided scenario. The more important consideration is whether the fiscal stimulus has that capital F or lowercase f. Unified government, we see $2 to $3 trillion of stimulus under a Biden regime. Divided government, probably more like $1 to $2 trillion. However, the stimulus plus an uneven economic recovery, we think will be sufficient to prevent a double dip recession. Now let's focus on time horizon. Near term, long term. We caution investors against quick emotional reactions. We all probably recall watching the election returns 4 years ago when Trump started to collect all of the electoral college votes. Stock futures started to melt downward. They reached a low of over 900 points at one point during the evening of the election. However, 24 hours later, those losses were erased. There was near-term optimism around infrastructure, which ultimately underperformed other sectors. So think about the near term, but focus on the long term.
Well, Stuart, what happens if we get a contested election and that transfer of power or the transition to the current administration that we have now? What could that mean for markets? We've never really had to face that at the level that we're looking at now.
It's an excellent point, one of real concern, and something that the markets, if you look at the VIX fear gauge, is starting to price in elevated volatility after November 3rd, suggesting that they have the same concerns that you just flagged. And in terms of getting clarity around the election results, we think of two things. One, expect delays in counting votes across certain key states such as Pennsylvania. However, on November 3rd, focus on Florida. They count their ballots prior to November 3rd, obviously continue to count them during the election date and evening. And if Biden is the Florida winner, we will get a much better sense as who will most likely win the White House. Because no matter how you construct all the different permutations of the Electoral College, if Trump does not win Florida, it's going to be very difficult to construct a win for him. So ultimately, we have conviction that a president will be sworn in January 20th. That result will be seen as legitimate both in the US and around the world. So then think about your investments. Think about that longer term positioning. Near term, it's going to cause some anxiety. there are going to be moments of concern over the next several days, at least subsequent to November 3rd. However, we see that dislocation and uncertainty as an opportunity to rebalance into higher conviction positions.
Yeah, that's an interesting way to look at that. That's the first time I've heard that theory. So the issue isn't necessarily who wins, regardless if it's Trump or Biden. It's policy priority that we really have to pay attention to, because that's what's going to set the tone at the end of the day. So which policy are you paying priority to?
Right. So there are several that we're monitoring actively, but for this conversation with your listeners, I'd like to focus on three: taxes, regulation, and healthcare. And as you know, in life, there's some things easy to say and hard to describe and do, and those are three examples of that. But let's take a crack at it. Let's discuss taxes. Under a Biden scenario, higher corporate tax rates domestically and internationally are coming. Individual taxes will be going up. However, investors tend to focus too narrowly on the bottom line tax impact without considering the top line realization of a stimulus. They're two sides of the same coin. The stimulus can accelerate growth. It can enhance revenues. And if you want to go back and lean on history, Obama raised taxes his first year of his second term, and the stock market was up over 30%. So under Biden's proposal, corporate taxes go up. The potential rollback would shift the corporate taxes in the U.S. from a current 21% level to 28%. But let's remember, before Trump, they were at 35%. So still lower than what most of us remember in our recent investment history. The other thing around taxes is that we need to consider when they'll be implemented. Likely to be discussed, debated, et cetera, in 21, likely to be more implemented in 22. And so think about earnings, think about the impact. Earnings went up around 8 to 9% when Trump rolled them back and dropped them. Now, if Biden proposes to raise them, we think maybe S&P earnings go down 5 to 6%, everything else being the same. The second topic, regulatory. Under Biden, there will be more regulation, energy, financials, but let's focus on technology. It's in the crosshairs right now with the DOJ. We actually think that these antitrust concerns are difficult to prove ultimately because they're premised on the idea of harming the consumer. Many technology companies, offer free products or help to lower the cost of goods and services for consumers. So the DOJ has a steep hill to climb. However, we do see a very substantial set of one-time fees, penalties, compliance costs that will impair near-term and potentially longer-term cash flow for many technology companies, but will not derail the ultimate sort of integrity of these very strong operational business models. Finally, healthcare. From our perspective, ACA and Medicaid will be prioritized over pursuing a public option, which, as a reminder for everyone, this is going to benefit insurers in the healthcare space. There's only so much political capital Biden will have. He'll focus on healthcare, given the pandemic especially. He'll focus on taxes, and ultimately we think that will benefit certain kinds of insurers.
All right, Stuart, we have a couple minutes to go here. So what should the key investment themes investors should be focusing on?
Equities, alternatives, fixed income. Equities, we think the markets underappreciate emerging markets. Total return opportunity is set up nicely as we expect further declines in weakening in the US dollar. We also think sustainable and impact investing is a huge and real opportunity in front of us. Alternatives, distressed investing, multifamily real estate. We see corporate default rates rising above 10% from mid-single digit levels today, and we see restructuring opportunities that can provide attractive, diversified return potential in someone's portfolio. Multifamily real estate offers durable yield and ballast as a substitute for the challenges of a very low yield environment in fixed income. And especially when we think about fixed income, let's remember, $1 trillion of stimulus at least. We expect GDP growth of probably 5+% next year. This combination is going to result in a more inflationary environment. Bond yields, we think, on the longer end of the curve are likely to go up. Inflationary break-evens are going to widen. Think about TIPS. TIPS can be an opportunity for certain investors.
And finally, what other topics are you discussing with clients? We've been so tied up with the election and COVID-19, but fundamentals, as you alluded to earlier, are going to have to start to come back into play.
Yeah, no, look, I'm glad you highlighted that, Jill. I think you put your finger on it. That is one of the many key topics that we are discussing with clients. I'd prioritize them in three ways. Underlying fundamentals matter more than timing the markets. The importance of alternatives to complement a core long bias portfolio, and the need to keep politics out of your portfolio. This is a time to invest with conviction in the winners, maintain discipline to avoid the losers.
All right, Stuart, great to catch up with you as always. Thanks for joining us on Trade Talks.
Thank you. Great to be with you. Thanks.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.